Good afternoon, everyone. I hope my mic is audible. If you can hear me clearly, just say hi on the chat. Again, if you can hear me clearly, just say hi on the chat. We're having a bit of connection issues on my end. Okay, great. Okay, so today, so apologies for the lateness. Was trying to set up my Zoom from my end. Okay, so I think we're good to go. Okay, so we've had a very lengthy discussion this week. We started off on Tuesday by talking about the market. We talked about how to get the overall theme of the market. Oh, hi everyone. I'm seeing guys are replying. Yeah, so we talked about getting the overall theme of the market. We talked about finding the bias and all that. Then yesterday we talked about finding the right entries in the market. Now, after you found your bias or general direction, you'd still need to know where to enter. And that's where finding the right entries came in. And that was covered quite a bit yesterday. Today, we're going to talk about risk management techniques. So when thinking about this topic, I know many of you have already studied how to use stop losses. We've talked about this in our previous webinars, how to set up risk a trailing stop loss, how to position size. And if there are things that you are not quite conversant with, I think they are covered extensively in our webinars, so you can just review them from there. So today I'd like us to talk about the general picture. So instead of focusing specifically onto the nitty-gritties, the details on the size of your position and all that, we have to step back a bit and talk about the general picture. So we're going to talk about a few key topics. These are 4. First one is considering your overall portfolio size, understanding the impact of losses on your portfolio. And if you can't see my screen well, just tell me on the chat so that I can zoom in. And then your win rate, and we're going to talk about correlations. So these are some of the mistakes that are rarely talked about when it comes to trading. I believe they're very important. So when it comes to the first one, which is considering your portfolio size, this is a very touchy topic. When you Google or when you search and talk about what's the correct position size, how much should you be risking per account, the general rule is usually risk 2% of your account. But then again, we usually have different account sizes. So we can't all be risking 2% when, for example, you have a very small account. So the percentage of risk that you have should be in line with your account size. Because again, you're trying to risk 2% in a very small account. Probably you're not also going to make as much with a small account. But if you're risking 2% maybe on a $1,000 account or a $5,000 account, then it makes more sense because your reward is also going to be within that range. So when you are considering how to treat risk, the first thing you need to do is to determine your risk tolerance. How much are you willing or are you able to accept when it comes to placing a trade? How much risk are you willing to accept? And that's a very also touchy topic. It sounds very obvious until you place a live trade and then you start adjusting your stop losses, because a lot of people do that. So it's good to consider your risk tolerance and be comfortable with it before you even talk about the risk percent. So in this case, if you have a fairly small account, then you can afford, most people can afford to risk a bigger percentage, because in overall absolute terms, it's still kind of a small risk. So the 2% isn't standard across all account sizes. That's one thing you need to know. 2% only makes sense if you have a large enough account, because at the end of the day, your level of risk should be equivalent to how much you're looking to take from the market. And if you're willing to take, say, 1% on a very small account, then it might not make sense trading for you. So usually with small accounts, you have to risk relatively larger amounts. But then again, you have to be cautious of the risk you're taking. You always have to be aware of your capital. So that's the first thing. Consider your portfolio size when taking the risk. If you have a fairly small portfolio or capital that you're starting with, then I believe it's good to take fairly larger risks. But as your capital increases, then you can start reducing the percentage, and then you tend towards 2% till you're comfortable with. So that's a general idea behind risk. That's the first thing. And then when it comes to losses, a lot of traders have a very skewed idea of how easy it is to recover an account. For example, if I've made a certain loss in my account, then what I'm looking to recover that account percentage-wise is usually higher. So in this case, for example, if I can zoom this closer, you can start with the far right. If I've lost 60% of my account in trading, that means I have, let me enlarge on these numbers. Yeah, so I hope everyone can see these numbers. So for example, if I've lost 60% of my portfolio, that means I'm not trying to make 60% again to break even. I need to make 150% of my balance to get back to break even. If I've lost 55% of my account, I need to make 122% of my current balance to go back to break even. So usually after a loss, it requires greater effort, greater concentration, just to get back to break even. And that concept should come out clearly. Risk is not linear. Your capital and effort is not linear. You can't assume that you'll need the same effort just to get back to break even, because you're giving yourself a harder task. And as soon as you understand that risk is not linear, then you have a greater idea of risk per trade, monitoring your risk, and trying to understand what it takes to get back your account to break even. So the recovery is never linear. For example, if I've lost 35% in this case, then I need 50%. I need to make 50%, 53% on my current balance just to get back to break even. So understand that risk is not linear as you move on with the account. And it generally is that way. And it applies also when it comes to profits. Yeah, it's easier to maintain your account, say with a 1% risk, with a 2% risk. But then every time you lose, then you must recognize that you need even more effort to get back to where you are initially. So that's the second thing. So for those who are joining us today, we are looking at risk management concepts. We're trying to approach it differently. We're touching on these key 4 topics. The first one is consider your overall portfolio size, in which case the account size determines how much you should be risking per trade. A larger account size means you can go to the general rule of 2% per trade or 1% per trade risk. But as your account size gets smaller, for you to make any meaningful returns, then you have to risk more. But then you still have to be aware of that risk as you go forward. Then the second one is understanding the impact of losses. Losses, your account doesn't grow in a linear way. Your account grows in a curvilinear way. In this case, if, for example, you lost 60% in your account, that means to get back to break even, you need to make 150% on that balance. So does that mean you have to take in more risk? Does that mean you have to trade more? And such things. Okay. So on the third point, we have, and this is one common mistake with traders, the discussion to do with win rate. So if you read through many blogs, if you watch a lot of videos, then you'll understand how traders try and relate win rate to risk reward ratios. And the biggest assumption is usually that your win rate, okay, for those who do not know the meaning of win rate, it's basically how many trades out of all your trades do you typically get right. For example, if I have a win rate of 60%, then that means I'm usually on average successful 6 out of 10 trades. How do you get your win rate? On your FX Pesa MT5 or MT4, you can just go to your history and then right click on it and say detailed statement, and then it will show you the details below, including your win rate. Yeah, so again, if for example, my win rate is 60%, then that means typically 6 out of 10 trades usually in profit. So a lot of traders like to discuss this concept when it comes to using your risk reward ratio. You've heard stories about if your win rate, for example, is 50%, then use a risk reward of 2 to 1 and such things. But it's important to know that there's a very big assumption that people usually make, which is assuming the probability of each trade is the same, of being right on each trade is the same. It's generally not. The win rate is not constant. And one of the reasons why it's not constant with each trade is, number one, market conditions can affect the setup. There can be news coming out, there can be a shift in sentiment, there can be changes in supply and demand. So each trade you get into is generally not going to be the same, which is what I make the case here. Each trade that you get into is generally not going to be the same as the previous trade. So your win rate is never going to be constant. That means your risk per trade needs to vary depending on certain probabilities. So in this case, usually traders have a couple of setups. You have high probability setups. Let me just share this fully so that I'm on the same page. Just a minute. Yeah. So usually, can everyone see this? I believe everyone is with me. Can everyone see my full page? Oh, yeah, it's visible. Okay. Usually, the risk-reward ratio, which is affected by your win rate, needs to vary. So traders usually group these trades in different sections. So if you have high probability setups, does that mean you're able to risk more on those setups that you're sure of, or those setups that have a higher probability of being right? Then there are those low probability setups. And with those low probability setups, do you need to risk less? So you need to differentiate between your high probability setups and low probability setups, because your win rate is never going to be constant at any one point. You need to understand the factors that might make your trades different. At any one point, you might be attempting to trade maybe a breakout retest or a momentum entry, and then there's certain news that comes out and the market drops. You know, your setup is probably okay, but it didn't work out because it was a low probability setup, because maybe news was coming out. So your trades will never be the same at any one point. And you need to factor in, when will I be making high probability entries and when will I be making low probability entries? And that then translates to the lot size you should be using per trade. Okay. Then finally, we have one more thing that I usually see a lot of newbies attempting to do, which is not taking into account the correlations. So you need to know the asset class correlations to better control your exposure. And it's something I'll show on the charts. So correlations, for those, if you don't know, simply how a change in one asset price is related to a change in another asset price. For example, sometimes you can get Euro USD and Pound USD are moving generally in the same direction. That's a positive correlation. Or maybe Euro USD and S&P moving in opposite directions, something like that. So you need to factor in your correlations when placing multiple trades, because at the end of the day, you don't want to be wasting your time when you're in a trade. I think I'll show an example of that. Let's see. Let me switch on to the charts very quickly. Okay, so this is Euro USD chart over here. We can see that on that, the market had this huge drop till this point. And then what happened is we began to move upwards like that. Yeah. Let's look at USD CHF. For USD Swiss, the market, the same time, went up and then began to drop like that. So assuming someone, just a minute. Yeah, so assuming someone came in and bought Euro USD, and then at the same time, they went and bought USD CHF. If you look at these charts side by side, one rose, the other one dropped. Why? Because they are negatively correlated. Why? Because they both share the same, they both share the dollar in their names. So in this case, when the dollar strengthened, what happened to euro? The euro dropped. And in this pair with CHF, the dollar strengthened against a Swiss franc. So imagine having a setup where you bought here and you bought here. That means you're basically canceling out these trades, and there's nothing you've done at the end of the day, because on one chart, you'll be gaining money. On the other chart, you'll generally be losing money. And you wouldn't want such a scenario to take into play, especially when you're making multiple trades at once. So when you're taking multiple trades at once, just a minute. When you're taking multiple trades at once, it's important to remember that there are correlations. So if you're about to, for example, here I've seen, maybe you've seen a sell setup, then you wouldn't want to be selling as well at USD CHF. Look at today's move. Today we've had general drop. This is the 15-minute chart for USD CHF. We've had a general drop in prices on USD CHF. And the market, in this case, had risen a bit from around the same time, but it's fairly sideways at the moment. Yeah. So if you're taking a position, for example, in Euro USD, then you should be cognizant of any other position that you're taking. Are there any relationships that you can observe that you should avoid so that you don't cancel out your other trades? So if I was to go back to, let me go back to these slides. First thing here it says is avoid opening several positions that cancel each other out. Because at the end of the day, if you take multiple positions and they start canceling each other out, that means you're not doing anything per se. The best you're doing is, yes, you've gotten a setup, but it's correlated to another chart that you might not be aware of. And both of them, you're in positions that are canceling each other out. Then that means you won't be making any money at the end of the day, and the position might be problematic. Then the other one is be aware of commodity currencies. So this is another source of correlations. We have currencies that usually move in line with commodity prices. So if I was to go back to this chart, a minute. Yeah, so if I was to go back to this, let's look at, for example, Australia dollar, which is generally correlated to gold. The reason it's correlated to gold is Australia exports a lot of gold. So an increase in the price of gold will mean an increase for the value of exports for gold. That means an increase in the price of Australian dollar. Usually such correlations take time over a longer time frame. In this case, we can see that we've had a general drop in the Australian dollar and then an increase like that. And if you are to look at the gold chart over the same time frame on the daily, what can we see? General drop and then an increase like that. So we can say the Australian dollar and gold are positively correlated. So if you're planning on taking a long-term position on either one of the assets, you wouldn't want to be buying gold, then selling Australian dollar, because you'll be canceling out the position. One position is obviously going to gain, while the other position will lose you money because you are in opposite positions, because generally they tend to move in the same direction. So that's it for today. We are not addressing things to do with lot size and technical indicators used because they are in the webinars. If you scroll through the FXpressor webinars, you'll find webinars to do with the details of risk management. But in this case, just getting a clearer picture and avoiding those general mistakes that traders tend to do. As we recap, remember, first, one of the things we've discussed is not getting into positions that cancel each other out. Because assuming if I was to sell at this section, I wouldn't want to come again and sell on USD CHF because it moves in the opposite direction. And the reason being, dollar is the dollar is the middle ground in this transaction. That means if the dollar strengthens, then it's going to correlate most currency pairs. Okay, so having said that, that was the lesson for the day. Getting the overall picture, let me just summarize this before we talk about 4MC, because someone has mentioned that. So get back to this. Yeah. Okay. So just to summarize it, first thing is consider your overall portfolio size. This affects how much you should be risking depending on your risk tolerance. Second thing is understanding the impact of losses on your portfolio. We've seen this graph over here, how much percent-wise it needs for any trade to go back to your. So if, for example, you are at $1,000 and you've lost $600, that means on the $400, you have to make a profit of 150% just to get back to $1,000. So it usually requires more effort when you're in a loss to get back to break even. That's basically what we are talking about here. Then we talked about your win rate not being constant. That means each setup is affected differently when it comes to how you are positioning yourself. So you need to have you need to know which are your high probability setups, and this involves backtesting, and your low probability setups. You're never going to have constant setups at the end of the day. If you assume you have constant setups, then there is something that you're not seeing in the market that you need to rectify. Okay, so that being the session for today, I'll briefly touch on 4MC because I think Annette has asked. Okay, so for 4MC, get to this statement over here. For MC, for those who are new, for MC is the organizing body that decides on policy and all that, and they usually release minutes and discuss on the general direction of the market. How do you set a break-even? Okay, we'll talk about that. So, because it's the central bank of the US, you're going to look at assets. We're going to start with generally assets from the US before we move on to how it affects the dollar and everything. And if you went through the statement, it took some time to go through it. Just a minute. And this ties into the topic of risk management today. So I'll just open an index, because indices are the most affected by statements because it's directly related to the market. Let's see. So let me open the charts. Okay, so we're on your charts. I hope everyone is seeing the charts. Okay, well, as the chart is opening, there was a lot of talk on jobs data, direction of inflation, and very little comment on how much they're going to raise interest rates. So how this plays out in the market is the central bank determines interest rates because they're trying to control both inflation and employment. So yesterday they were still very adamant that inflation is persistent and that the jobs market is very tight. That means there are a lot of new openings and not many new people looking for jobs. That's a good thing for the economy, but it's a bad thing because it gives them room to continue raising interest rates. Because if the economy is doing well, usually interest rates hurt the economy. But if the economy is doing well, then they have leeway to continue doing that. You're looking at, the last time I checked, a terminal rate of around 5%. That means they might raise interest rates up to that point. Typically, usually what the central banks do is you try and raise interest rates until interest rates is higher than inflation, and that's when inflation starts going down. So the Fed is still very adamant on inflation, and that means they are still very aggressive, and that might affect asset prices negatively in terms of stocks. Yields might stay higher, and the dollar might continue being stronger. So it's good to go and do further research on that, but it seems like they have not changed the tone from what we saw last year. So if you were to look at how the market reacted yesterday, this is H1, the tone in the market, the mood in the market was still, investors are still trying to decode, but just reading the minutes will tell you that the reaction wasn't very, or the Fed wasn't very, they're not changing the tone. So we might see a continuation of last year throughout the beginning of January and February. Who knows? Maybe if inflation stays lower, things might look positive again, and we might start seeing a weaker dollar and stronger stocks. But at the moment, they maintain their tone. So we expect the markets to behave in the same way they did last year, basically. But again, you need to go do further research and just iron out those things, use your setup, use risk management. That's the general outlook. In the markets, the reaction was very muted. A bit slow on this. think my MT4 is hanging, so just a minute. So investors initially are looking for any excuse to take the market higher. But then again, this needs to zoom in a bit. Waiting for it to zoom. Yeah. So investors are looking for a lot of reasons, because yesterday's statement was very hawkish or was very negative towards assets. So despite that, investors are looking for reasons to take the market higher, but the current mood of the market or the current sentiment is they're still aggressive, and that's going to affect the charts. How this sinks into risk management is, yesterday we saw a lot of volatility when the minutes were coming out. Okay, I think my chart is not. Need to zoom in this. So just a minute. So, okay, while you wait for the screen to zoom in, yesterday we saw a lot of volatility, and that's one of those reasons or one of those areas where we have low probability setups, because you're not quite sure of how the market. You can see that there were so many weeks in the market around yesterday on the S&P. Now, as a trader, if you're looking to trade in this case, you do know that during news, all your setups, or probably most of your technical analysis setups, are going to have a low probability of impact. Why? Because you have higher volatility in the market. So does that mean if you find a suitable setup, you need to risk less, or you don't need to trade at all? So that's something to think about when it comes to attempting to trade. But then again, you can just go and view the statements on your own in the Fed website. I believe it's still there. Then there was a question on how do you set a break even? How do you set a break even trade, or how do you calculate it? Maybe Ellie, you can clarify for us on that. And then can you touch on NFP market reaction as well? Okay, so if I remember correctly, because I brushed through the statement, they did acknowledge, yesterday we had JOLTS opening data. JOLTS is basically an indicator of businesses opening up for jobs. Yeah, and if businesses are opening up for jobs, then that means the economy is generally doing well, despite us being in a recession. So if businesses are coming in and they're requesting for more workers, then that means maybe the recession risk might be over-exaggerated or something like that. So because the JOLTS report came out very positively, there were a lot of businesses looking for more people to hire, then probably speaks to what to expect with NFP. At the moment, we have what we call a tight labor market. That means that there are a lot of companies out there looking for employees, but people are not applying for jobs. That means we have a lot of guys already working, and it shows sign of a very, it's a sign of a very strong economy, because people are sort of is almost full employment and people are already in jobs. Having said that, if you have a strong labor market, the only problem the Fed is fearing right now is the fact that companies might start bidding for workers, meaning they might start raising salaries. And if you raise salaries, then you have a problem called wage spiral inflation. It means there is more money in the economy, people are earning more, and that's an inflation risk. And that's where then it ties back into the inflation problem. So generally, a positive reading tomorrow might indicate that the Fed still has leeway to tighten the economy. And tightening is usually negative for stocks, positive for dollar over the long run. So it's something you need to take into account. So if JOLTS yesterday was positive, then you'd expect the job market to be really strong. And one thing you need to take note of is they usually tend to look at a series of data and not just one data point. So tomorrow's NFP, as much as it is important, you still have to look at it in relation to the other NFPs. Is a trend upwards or downwards? And that's how the Fed looks at it. That's why you usually see a spike upwards and then the market corrects itself, usually within the same range. Again, when it comes to risk management, some traders opt to avoid such sessions entirely. Some traders are active in those sessions. And then there are others who tend to reduce their positions. But it's going to be a good indicator of how much room the Fed still has and whether we are going into a recession globally and with the US economy. I believe Ellie has not refreshed the question because I wasn't understanding the meaning of break-even. How do you set a break-even? But generally, I'll just repeat. So go back to the minute. To go back to the slides, we'll just talk about that again. So let me switch back to slides. When you talk about break-even, if, for example, I've lost, let's use 50% of an account. Say you had $1,000 in the account and you've lost $500. You're left with $500. Does that mean you have to make 50% to get back to break-even? Because now 50% of your $500 is $25. So in this case, you have to make 100% profit on your 50%, on your $500, just to get back to where you are at $1,000. And that's what this chart shows, that you might need to risk considerably more if you're attempting to aggressively get back to break even, because your account now has a lower balance. So every risk percent-wise per trade is more. You need to take that into account when you're trying to, or when you're attempting to trade. Okay, do you have a webinar on Fibonacci? I'm very interested in using it to set my stop losses and take profit. Okay, Pauline. On Fibonacci, let's go to the charts. So the question is how to use Fibonacci to, and if you have other questions, we can address them as we go, because we have until 55, around 3:55. So if you have any questions till then, you can just type them on the chat as we discuss this. So I hope I've answered the question on 4MC and NFP, for those who are curious with that. Okay, so when it comes to Fibonacci, let's put Fibonacci on this. So Fibonacci is simply a measure of retracement on a trend. You're trying to measure. So my MT4 today is a bit slow. I think I need to delete this. And this is for Fibonacci retracement, not Fibonacci extensions. Okay, so assuming you wanted to know on this downtrend over here, how much of this move has been recovered. So if this downtrend over here, you're observing this move, how much of this move has been recovered from this downtrend? That's when you use your Fibonacci tool. And in this case, I'll plot from there to here. I hope it comes out. Let's see. Okay, need to reset this. Okay. So now I've plotted from the beginning of the trend. Just a minute. Okay, I think it's taking some time to process, but yeah, just a bit. Okay, while it's adjusting, so you're trying to measure how much of this move has been recovered with this second wave. That's when you use your Fibonacci. You're simply measuring, for example, in this case, you're seeing that it's gone all the way up to 61.8%. So with this impulse move here, this current move has recovered 61.8% of this move. That's simply what Fibonacci is telling you. So now there are key levels that people usually assume. The retracement move tends to respect a lot, and that's the 61% retracement, 50% retracement, and that's 8% retracement. So when attempting to take trades, generally traders will use these levels as turning points. We discussed about turning points on Monday, so you can go look into that webinar. So you usually tend to place your stop. If, for example, you're in a sell position, you'd place your stop above the 61.8% level, depending on the current volatility of the market, or depending on how wide the candles are at the moment. So if a candle is 20 pips or 30 pips, or most of the candles are around 20, 30 pips or 5, 6 pips, then you need to take that into consideration when setting your stop loss, or rather just use an ATR for that. Okay, I think that wraps up today's session. The discussion to do with swaps is generally based off the interest rates of different currencies. So if you're holding a position overnight, you just take what the interest rate is for the position that you're long and the position that you're short, find the difference, and then you're going to get the swap charge for that. So having said that, I think that marks today's session. We've talked about risk management. We've talked about, we've covered a bit on market analysis. We've said that the setups usually tend to have different risks or win rates because of the various factors that are affecting the market. And having said that, I think we will stop our session there. Rufus, I think, will be in the next session from 4. And yeah, enjoy your trading today. We'll have a lot of activity between now, which is 5:30, and tomorrow, because tomorrow we have NFP. For those who are looking to trade NFP, today there's also going to be a lot of activity considering the minutes were released yesterday night. So try and see what you're going to do with that. And having said that, enjoy your trading session.